we'll be talking about something that's entirely different from trading today, right? Whatever we're planning to do, or this thing about long-term investment is it's very different from trading, right? So the mindset, how you approach this is going to be very different. There is still going to be risk management processes, right? Where you manage your risk and all that. But when it comes down to approaching it on how you can manage your investments, we don't talk about trades anymore, yeah? On how you can manage your investments and stuff, it's entirely different. So today I'll be obviously this is just not fully this is not gonna be fully uh it's not gonna be fully how am I supposed to put this? Um Everything you need to know, right? But this is some good basics for you guys to have, right? Some good basics for you guys to have before we kind of go on over to talking about other stuff, right? Like how to actually find investments, how do you know if the company is good? All these are very important stuff that we don't have time to go through today. But for now, right, with the how the market has been correcting recently, I think it's good for you guys to start off with just having the mindset when looking at these long-term picks and also how you can manage your risk with the long-term stocks. Okay, and then obviously how I think this is one important part of it, how you can make semi-passive income on long-term picks. Okay, even if you own them or even if you do not own them. I'll go through this at the end, okay, because this one is a little bit more complicated. Pretty sure some of you guys over here have heard about this before, but there are also a lot of you guys that probably don't know about this, right? I mean, if you guys don't know how to use a stop loss, I'm pretty sure you guys don't know what is this about. Yeah, but it's okay, keep an open mind. And if you have questions, we'll leave it to the end. Okay. Now, the mindset when we look at long-term picks. Okay, so first off, right, for the entirety of what we do, from day-to-day perspective, right, is trading. Now you have to understand one thing, a couple of things is different, right? When it comes to trading, okay, this is where you can get instant gratification for your stuff. You buy and sell stocks, right? You buy and sell stocks within the day, you get instant gratification. Now, when you look at long-term investments, okay, you cannot expect results in 1 week, in 1 month, in just a couple of months as well, right? We're really looking at to hold them for a couple of years. Okay, I'll give you guys one example. Right, I'll give you guys one example. So now we're really looking to hold them for a couple of years. Okay, so right over here, okay, for let's say we look at this, right? So for me, I invested in this company over here, SFM, at 2022 at $20. Sorry, $28 or something like that at 2022. So roughly around here, right? Roughly around here. Okay, around this area over here, right? So you can see that from 2022 to 2025 this year, okay, it's now 2025, we've actually hit like a huge move to $178, okay, which is an impressive move. Now, when we trade, right, when we buy, it goes up 10, 20%, we sell to take profits, right? Because the companies that we trade in, they're not good companies, right? Financially speaking, they're not good companies. Sure, they can go up, but that's because of trading activity, right? It's nothing to do with the company itself. When we invest in it, all right, we're actually investing in the company. So once you actually sell off your investments, right? When should you actually take profits on your investments? Now, there are two ways to approach it. Number one is whenever you feel like it, or whenever you feel like you need the money, right? So if you want to take your profits off that, go ahead. Okay. Now, number two is you sell your investments when the company is no longer able to be a good company, right? So this is very different from small caps. See, even if I'll tell you guys a couple of investments that I have right now. Stellantis is another one that I have, right? I have this at $21. Okay, you can see right now I'm down $9 per share, but the company, okay, the company is still okay for me, at least based on what I'm seeing. The company is still fine, so I'm still holding on to it even though it's down, right? Unless the company has entirely changed the structure, then I'll close it off, right? When the company is not able to remain profitable or it's not doing good, blah blah blah. There's some change in the business structure, the company structure. That's where I have to close it off, or that's where I'll close off my investments, right? Because I don't want to hold on to this anymore. One example is also Mastercraft. Okay, this is a boating company, a luxury boat company. So it was doing really good before, but I think the luxury boat industry recently has been hit, with slow sales and whatnot. And that is when, I had this at around $28, it went up to 35, right? And when I start to see the slow growth of the company, I sold this off at around 31, 32s, right? Because the sales weren't doing good, the industry wasn't doing good. We're not too sure how well this is gonna come up from it. So that's where I close it off and I move on from it. It has nothing to do with charts. Okay, when we trade stocks, okay, when we day trade stocks, okay, we're looking at instant gratification, buying and selling on the individual day itself, right? So these are things that you can expect to find activity every single day. When we come and talk about long-term investments, completely different, right? Don't expect to buy today and see results 1 week later, 1 month later, or whatnot. Even if there is results 1 month later, okay, we're not interested in that. All right, we're not interested in that. When we invest in a company, we're looking at the company itself. Okay, we're looking at the company financial statements, income statements, balance sheets, cash flow, how much free cash flow it has, what's the operating cash flow and whatnot. We're looking at all these important numbers. We're not looking at the chart at all. When I sold this over here, it wasn't because it was going down. It was because the company is no longer able to sustain its aspirations, or rather, there is in this industry itself, there is a change in the growth for luxury boatings, right? So that's why I did not like it anymore. Even if, let's say, even if right now this thing's at $39, $40, $50, okay. If let's say it's trending up, but the company reports that it is having slow sales or growth or anything like that, I would probably reduce my position. All right, I can hold on to it a little bit more because it is above my entry if that's the case, right? And I'm not too disturbed by it, but I can hold on to my position a little bit. So, but I will offload my position because the earnings has said that it's not good, and earnings generally happen every quarter, right? So how often will we be checking on these long-term tickers? Will be every quarter. And I think I mentioned this to you guys before, right? When we look at long-term stocks, okay, these are or rather these long-term plays are tickers that we do not look at every single day, every single month, or whatnot, right? We're actually looking at them every single quarter, if not sometimes every single year, right? So we do not spend a lot of time looking at them every single day. There is a trade-off. You want instant gratification, you go for trading. All right. If you want instant gratification in long-term investments, it's not gonna work, right? It's like asking an apple for an orange juice, right? It's completely different. So that's why your mindset has to be right first. Okay, your mindset has to be right first, okay, when it comes down to this. All right. Now the second thing is the managing, all right? What you guys should see when it comes to stocks. As I mentioned earlier just now, when it comes to investments, when you invest in a stock, we're not looking at charts at all. All right, we're not looking at charts at all, nothing like that. Why? Because the company's value increases with how it performs. Now remember this, whatever you see in the market from the day-to-day perspective, right? The stock price, this is being managed by algorithms and traders. Okay, they don't actually depict what the company is valued at, in a sense, right? They don't actually depict what the company is valued at, right? And also, the company's value doesn't mean, rather the company's value sometimes can be overvalued when the stock price is above the company's value, right? We'll take, for example, maybe we'll talk about NVIDIA, okay? Based on NVIDIA numbers and everything that I've calculated on my own, for me, the value over here is around $100, right? That's kind of where I feel like the current NVIDIA is worth, right? Obviously, when the AI hype comes, when quantum hype comes, and all that kind of stuff, they ignore all this over here, and people buy it up, which pushes the price up, right? Which is why it caused an influx in movement over here. It's the same thing for Tesla. Tesla for me is very overvalued, but because it's a huge cult, people are buying it and all that, right? It just keeps going up. Okay, but does it mean that you should continue buying right here? Okay, no. All right, none of us can ever time the market. Always remember that, right? But so long as you know what you're buying, so long as you know what you're holding is of fair value or undervalued, right? You can hold on to this until the company changes its structure or it loses its ability to maintain strength in the market share. Then that's where you close down. But if not, right, economic events like recession or any sort of pandemic, those are not economic events, right? But pandemic stuff that causes the price to go down, we call them, these are good opportunities for you guys to grab these good companies at discounted price, because once these recession is over, we will know that, if the company is good, it will rebound up, right? Because this is also the time where it allows for companies to drop so that you can kind of get it at the price that you want, right? Because again, day-to-day movements of the price action day-to-day movements of the price movements and stuff, right? These are the ones that causes the stock price to go up, right? It's not because Nvidia is worth $153 per share. Okay, this is, remember, after split, right? It doesn't mean that Nvidia is worth $153 a share, right? Because if it is, then why did it drop, right? You can see the price movements over here depends on traders every single day. But as you invest in the stock, you should not be looking at trades, right? You should not be looking at trades. You should not be looking at you should not be treating this like a trade, right? You know what you own, you gotta know what you buy, you gotta know what you own, and then be confident in what you're holding. Another thing why you don't look at the chart is, let's say for example you bought Nvidia over here, right? We look at technical analysis, we look at the chart, we look at patterns and stuff, and over here we see that, oh, this is an ascending triangle pattern, okay, right? This is an ascending triangle pattern and stuff, right? So as the ascending triangle pattern breaks out, right, we take our entries over here as per, if we approach this with a trading mindset, we look at the chart, we base our decision on technical analysis, right? We take our entries on this breakout over here and have our stops underneath $42, sorry. That is what we're talking about in terms of approaching this on a trading mindset. But how would you know whether this ascending triangle breakout is going to make this go from $55 to $153? No, you cannot, right? Because if the company is good, if the earnings is good, if the company is good, it will eventually go up, right? The value of the company will go up, the stock price will eventually go up. This over here has a lot of trading activity, so it might be a little bit manipulated, all right? Because there are a lot of people that talk about this, but we talk about tickers like SFM. Okay, this is not, pretty sure you guys, maybe a lot of you guys over here don't even know about this company, right? Maybe you guys don't even trade this company at all, right? Not a lot, right? If you compare in terms of the volume and stuff, right? The daily average volume this thing has is only 1.7 million shares, okay? But if we look at NVIDIA, obviously this company has a lot more volume because people know about this more, right? So this has a daily average of 288 million shares. So SFM is a company that most people don't know about. But because the company is good, because their earnings is good, because what they do is good, right? They are opening more stores. They are they're not making money. They are making money, right? So every earnings, price goes up. 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 And earnings again, price goes up right over here. I mean, this one over here was a drop. I mean, at the end of the day, this is a little bit too high right now because it used to be worth 20 something dollars, right? Going to 178 is crazy. But you see, I do not look at the stock, the chart. The chart over here, when I bought this over here, it's not going to tell, there's no amount of technical analysis or indicators that's going to tell me that this ticker is going to go to 100 plus. Right? Can you tell me, if you guys say yes, you know where this is going to go to, can you guys tell me where is Apple going to go to based on this chart? 5 years down the road. Can you tell me that? Can you guys have a number for that? Can you guys tell me based on this chart right here, or based on all the information you have from this 20 years, based on all the information you have over here? Now tell me, where do you guys think Apple price is going to be 5 years down the road? Can you tell based on the chart? Does the chart tell you where it's going to go 5 years down the road? Obviously, it's not going to, right? There's no way anyone could know. So your job as an investor, same thing as your job. If we're talking about trading, right? Your job as a trader is to ignore the what if, ignore the future stuff, because none of us can ever see that shit. You see what's in front of you, you apply technical analysis to it, you trade it, take your money, go out, right? With a trading mindset. When we talk about investing as an investment mindset, you look for companies which are good, find out what's the value of the company. Remember, stock price doesn't equate to value, okay? Stock price does not equate to value, all right? Stock price, the price of the stock is being driven by greed, fear, traders. Okay, I told you guys this as well before. When we look at the market, all right, when we look at the market, there's quarters, there is an earnings every single quarter, okay? And these, if without traders and algorithms, whatever the case is, before every earnings hit, right? There is not supposed to be any sort of price action at all because there is no one trading. When the earnings hit, you see the price goes up, stays there. Up and down stuff is trading activity, right? It's not because the company is doing this and that, it's how it just goes up and down like that. No, right? Every earnings impacts the price of the stock, right? Every earnings impacts the price of the stock. Just because it fluctuates up and down daily, it has nothing to do with the company at all. It is all traders and algorithms, okay? For the stock, for the company to be what it's worth, right? For the company to be at what it's worth, eventually in the long run, if the company is good, it will reflect its price, right? This is what Apple is. You can see the chart. All these are very good companies, right? In the long run, it will reflect what it's actually worth in the long run when the company is good, right? You see that Apple, Nvidia, all these blue chip stocks, right? All these large caps. In the long run, the company will review that it's good. But the thing is, can we guess what it's gonna do 5 years down the road, 10 years down the road, 20 years down the road? We cannot, right? We don't know based on what the company is gonna be valued at that point of time, 2, 3, 4, 5 years down the road. We cannot predict that. Same thing, the chart is not gonna tell you when Nvidia is gonna go 5 to 10 years down the road. So it's impossible to look at it like that, right? So when we trade, we do not look at the charts. I mean, we look at the charts, but we don't try to guess anything. When we invest, we do not look at the charts at all. Doesn't matter, okay? Right? We do not look at the charts at all. Okay, I'm gonna show you guys another example. All right, this is so obviously I'm not trying to show, or rather, I'm not trying to say bad about anything, but this is an example that I think is kind of good for me to talk about, right? So this guy over here is called the long investor. Okay, so he talks about a lot of he talks about a lot of long-term stuff, right? And you can see that between whenever he talks about the long-term stuff, he keeps adding in technical analysis to it and all that. I don't agree with this because again, right? Technical analysis should never be part of understanding what the company is valued at. You don't tell me that this ascending triangle pattern tells you that this sticker over here at 2024, right? At the start of 2024, when you saw in the video breakout, you don't tell me that this thing is going to go to $200. So you don't tell me this is going to go to $150. There's no way this can tell you anything, right? You tell me this is what you see on the chart for NVIDIA back then. How can you know this is going to go to 150 from here, 120 from here? Impossible. You're not going to know, right? You're not going to know, right? Is this because the company is doing well, right? Because of the AI hype as well, that hype that helped it. That's why it went up. Because of what the company does. It's not because of what the chart is doing. It's because of what the company does, right? So when we invest again, like I said, when we invest in a company, right, for the mindset, we make our decision based on the earnings report, based on the numbers, based on whatever the conference call is, whatever the stuff is. We do not look at the charts, right? So how do you know when to actually buy these stocks, right? How do you know when to actually buy these stocks? Okay, so when we look at trading, we look at technical analysis, right? We look at technical analysis, okay? You look at patterns, right? You look at patterns, okay, you look at patterns, you look at candlesticks, right? And all that kind of stuff. Can you guys see what I'm writing? Yes, no? Look at candlesticks and we look at volume, all this kind of stuff, right? Can you see what I'm writing? Yeah. So right here, okay, right here, these are all we see. Okay, we look at this when we make a decision, right? And then obviously we're gonna have our stop loss, right? That's how we manage our risk, which I'm gonna talk about later for long-term investment, right? But when we look at investing in a company, okay, right, we do not look at charts, right? We look at investing, okay, right? We do not look at charts. Okay, look at the financial statements. We look at the financial statements, right? We look at financial statements, look through earnings report. Okay, so it's less taxing because again, we don't really need to look at this every single day, right? We look at this every couple of months. So it's a lot easier for you guys to kind of understand this, right? And obviously if there's any sort of ad hoc bad news and stuff, then we gotta react accordingly, right? But ad hoc bad news are the things that's not part of the schedule, so we will never know about that, right? It's less taxing, right? So we look through earnings report and we identify what the company is valued at by calculating using whatever formula. right? There are lots of formulas to calculate what the company is valued at out there. Okay, some of you can use the DCF, cash flow DCF method, discounted cash flow method. Some of you guys may use the free cash flow method. Some of you guys even use EPS or PE ratio, right? To use these metrics to find out what the company is valued at. There's a lot of stuff out there. You can just go over to Google, right? You can just be like, what is we call this intrinsic value, okay? What is the intrinsic value of Apple? Or let's say Tesla, right? Let's say Tesla. Okay, what is the intrinsic value of Tesla? Right here, you can go over here and see what is the intrinsic value of Tesla. And there is going to be a lot of, again, different ways of calculating it. You can see some people calculate it to be $46. So they're trying to tell you guys that Tesla as a company is worth $46. Right now, if you look at Tesla price, this is worth $249, right? So it's like, would you buy something that's worth $46 at $200? We put it in terms of retail stuff, right? We talk about watches, Rolexes and stuff, right? We talk about Rolexes and stuff, right? If everyone in the market is selling at $11,000, for example, right? Just a basic entry Rolex watch, right? $11,000, okay? And there's this one person that's selling you at $5,000, okay? There is no change in anything. It's not fake. Everything's brand new. It's selling you at $5,000. Would you buy it? Right? You definitely buy that, right? But another person comes up to you and you know that the market price for, let's say, a normal basic entry Rolex watch is $10,000, $11,000, okay? But someone's trying to sell it to you at $40,000. Would you buy it? Right? I'm pretty sure you won't, right? Because you understand the value of the watch. You will not pay the price for that. You understand what the value of the watch is, you will not pay the price for that. Right? So if you understand what the value of the company is, right? If you truly understand what the value of the company is, you would not pay for it. Right? If we talk about in terms of watches, it's easier, or Hermes, Birkin bags, or whatever the case is. We talk about this one over here. Okay, we talk about watches and stuff, right? We see like a very basic entry one, basic entry watch, right? We talk about this. Okay, if you know that this thing is worth, whatever it is, sit over here, right? $6,500. Okay, if you say this is worth $6,500, right? If someone comes up to you and sells you for $11,000, would you buy it? I'm pretty sure you won't, unless you really have the money, right? And you just want to throw it off, then it's fine. But in terms of rationality, would you buy something at $11,000 when you know that it's only worth $6,000? You would not, right? But if someone comes up to you and tells you to buy this at $3,000, offers you $3,000, no catch, brand new, same, it's completely fresh off the box, would you buy it? I mean, I would, because it's cheaper, right? I could even buy it and sell it after at a higher price for profits, right? But if someone sells this to you at $11,000, you're not gonna be able to resell it, right? Okay, so obviously I'm not talking about stuff like, oh, if I have money, but this is a gift and whatnot. We're not talking about that. Right? I'm just trying to tell you guys that when we look at stocks, okay, when you understand what the value of the company is, it just doesn't make sense for you to be buying this at $488. Because in the long run, when everything dies off, when the hype dies off and everything, the share price should reflect what the company is valued at. Okay, this is why when I tell you guys to trade small caps, I always tell you guys to take your profits and stuff, because in the long run, or whenever the volume dies off, the price will revert back to what it's valued at. Right? That's why when we trade small caps, we're gonna have stop loss and stuff. Okay, but when it comes to investment, completely different, right? Because if you don't have stop loss back then we talk about two-way, right? Remember this, stock price does not equate to stock value. This one over here was the talk of the town back when 2020, right? This was the talk of the town back in 2020. This shit went up from $7 to $66. People thought it was gonna go crazy, right? But this company is not a good company, right? People were just talking about this because of the weed legalization, and that is just a short-term, hype. And people are hyping this up. So when they hype this up, stock price goes up. Why? Because stock price is being driven by traders, by human emotions. but it doesn't represent that the company is valued at that price. Remember, price isn't equal to value, right? It doesn't represent that the price that the stock price is, the stock value is at the price. I got a friend that got this at $60. He's stuck in this. It's 50 cents right here. If the company doesn't recover, right, or doesn't change its method of operation, doesn't continue making money and stuff, do you think it's ever going to go back to $60? No, because the value is that it's simply not valued at $60. So why would you buy at 60? If you know that the company's value is $20, right? And this thing is 60. Buying this over here, you're crazy. You probably have a lot of money to lose, right? If you do that. Okay, unless you're remember, I'm talking about investing. When you're trading it, fine. We're looking at the chart. We don't care about the company's value, we don't care about the statements, we care nothing. We look at the chart, we trade based on the chart. But when we talk about investing, if you know that the company's value is $6, why would you buy at 60? Right? It's the same example of whatever the watch I used just now. If you know that this watch is valued at 5,000, why would you buy 11,000? Right? You want to buy it when it's of fair value or undervalued. So there you can see there's many different ways of calculating. Right? There's very different ways of calculating. So one of the famous ways of calculating the value of the company is by using the DCF method, right? And you can see that based on the DCF method, it is overvalued by 82%. So would you buy Tesla over here at 249, or rather, at $488 for investment? If you're buying it at $488 for investment, it only can mean two things. One, you got caught up in the FOMO, right, of someone telling you to buy it, you bought it. Number two, you don't understand the company enough, right? You're just randomly listening to other people and you buy it. And that's why you get caught up in shit like this. Right? When it drops, you start to panic because you do not understand what you bought into. You have no clarity. You're just blindly following others, right? You don't know what's going on. So when it drops, people that bought this at $488, for example, right? If they truly know what they're buying into this, they will not panic on this drop because they have full faith in this. So same thing for, but if you blindly bought into this because of a friend recommendation or because you saw a lot of hype on this, then what you're doing is you're just buying into the hype. Right? It's the same for him. So a lot of people was hyping this up back then when it went to $70+. Look at where it's at right now. Right? Look at where it's at right now. Right? Same thing for Palantir. A lot of people are hyping this up, right? It's dropping right now. Okay, I'm not saying that these are bad companies. I'm just trying to say, once you understand what the company does and you understand the value of the company, right? And you understand, you will not be caught up with all this FOMO and stuff because you're well informed, right? Information is power. Okay, there are some different ways of calculating the intrinsic value, right? But it's just everyone's way of calculating is very, very different, right? Everyone's calculating very, very different. But even so, even if this is $209, this is still way, way overvalued for Tesla. It's actually insane, right? That people are buying this at 88 for, and they're telling me that, oh, I'm buying this for an investment. Might as well you wait for it to drop, since we're in this market condition right now. All right, so your mindset has to be there. Do not wait for short-term gratifications, or do not expect short-term gratifications because when we buy it, we're looking to buy into the company. We're not buying the stock or whatever, right? We're not buying it because the stock price looks good, right? We're not because the chart looks good. No, right? Nothing to do with charts. We're buying this because we trust in this company that this thing can grow. Okay, that this thing is gonna go up, right? And then obviously you do not look for short-term gratifications, because if you do that, then you're gonna miss out the long-term move that the company, if it's good, will project for you. Imagine if you look for short-term gratifications, bought at $55 over here from NVIDIA, you sold at $61, and then you only find out that this thing's 153 right now, right? And why do you sell when the company is still doing good? Stupid, right? So we only sell when the company starts to be like shit, or it starts to underperform. But if not, no reason to sell, right? Completely different from small caps. Okay, completely different from small caps. Now, next thing I want to talk about is how do you manage risk with long-term stocks, right? How do you manage risk with long-term stocks? So so when it comes to technical analysis, right? When it comes to technical analysis, when we look at technical analysis, or rather when we come to trading, right? How do we manage risk is by watching the chart, right? Having let me see 1 second. Manage risk. Okay, manage risk right here. We'll do it by watching the chart, having stop loss, okay, and also watching size, right? This is how we manage the risk when it comes to trading. When it comes to investing, okay, it's the only way or the how we could manage our risk is by diversifying our passive wealth. That's number one. Number two, diversifying our industry investment, right? Our investments into different industries. Because there are some industries that work well during a recession and whatnot, right? It's not there's not going to be an industry that works well during a recession and works well in a non-recession. Okay, now for those guys who don't know, there are 11 different sectors in the market. All right, there are 11 different sectors in the market. Okay, so the first one over here is going to be communication services. Okay, second one over here is going to be consumer discretionary. Okay, the one over here is going to be consumer staples. Fourth one is going to be energy. Fifth is financials. There's banks and stuff, right? Six is healthcare, right? We all know about the shit, Pfizer, stuff all the stuff. Industrials is another one, and then obviously the information technology, infotech, right? This is technology and stuff. There's materials, right? Raw materials like gold and all that. Real estate, and last one, tech. So there are 11 different industries or the sectors, okay, that the stocks are categorized into. This works even for small caps, okay, but we're talking about investments right now. So when I say when I talk about this right here, I'm talking about when I say talk about this diversifying our passive wealth, I'm talking about let's say for example you have $100,000. All right, savings. I'm talking about savings, yeah? I'm talking about savings. Now, remember, this over here is money that we can put inside safely because, again, we're not putting our money inside trades that companies will go bankrupt for. We're putting our money inside good companies. So you can be brave enough to put a huge chunk of it, right? I'll tell you guys, for me, okay, let's say if I have $500,000 in my bank account, right, I'm going to be taking $300,000 of it, putting inside the stock market, right? Let's say if I have 500,000 of savings, right, or rather, wealth that I don't really have, or sorry, wealth that I have but I don't really use it. It's just sitting inside my bank account. I'm gonna take $300,000 out and put it inside the stock market to invest in it, not trade, right? Not like put into risky stuff like trading, to putting inside and investing a stock to invest in. Okay, but again, this is, let's say for example you have $100,000 sitting in the bank, right? Not really doing much of anything. It's just gonna don't know what to do with it. Okay, you don't know what to do with it. You have $100,000 inside the bank. You want to think about whether you're an aggressive investor or a passive investor. Now, if you guys are a passive investor, then you'll pretty much segregate your money inside here into two things. One, an ETF, right? It could be VOO, SPY, SPLG, doesn't matter. All these are low cost index funds, right? Next one over here is going to be cash. Okay, so your cash, right? So the percentage is up to you to work out. Some of you guys maybe, I like to put 40% inside here. I like to put 60% inside here. Completely up to you, right? It depends on, again, how you want to manage your money. That's it. That's if you're a passive investor. Now, if you're an aggressive investor, right? If you're an aggressive investor, okay, right? I'm not really talking about like going crazy and shit, taking like huge risks and stuff, yeah. If you're an aggressive investor, then you'll split your money into ETF, cash, and then the last one is stocks. Okay, because when you put your money inside ETF, you're technically investing in stocks already, right? If you put your money inside SPY, you're technically investing into Apple, right? It's just because SPY is basically a basket of stocks that it tracks. right? So if you put your money inside that, then basically you are already investing in stocks as well, right? But it doesn't, obviously it's not going to grow as quickly as the individual stock itself because it's just tracking a bundle of it, right? So if you're an aggressive investor, then obviously you put money inside ETF, cash, and stocks. So let's say you have $100,000, right? For me, let's say I'm just gonna be like, okay, you know what? I'm an aggressive investor. I'm gonna put 30% inside over here. Sorry, I'm gonna put 30% of my money inside ETF. I'm gonna put 25% cash, right? So the cash can be for emergency or whatever the case is, right? Can be more emergency or can be for side cash that if let's say there's a dip, right, and you want to use the cash to buy more stocks, then you can use that. Okay, because all these are tied up already, right? So 30% of that is going to be $30,000. It's going to go inside a VOO, SPY, SPLG, doesn't matter, right? It's going to go inside this over here. Okay, it's going to go inside this over here, right? Now remember, when I talk about this, I'm talking about how to split your money up, right? I'm talking about how to split your money up so that you don't need to you're not needing this money. Remember, you're not needing this money. This is savings, right? Because some people, when we talk about savings, they literally just put their money inside, right? They literally put their money just inside the stock itself, right? They literally just put the money inside the stock itself. But when we talk about savings and stuff, right? I'm sorry, they put the money inside the bank. Sorry, right? They put the money inside the bank. Okay, but when we talk about savings, okay, we can put our money inside stocks as well if you know what you're doing, right? Some people don't know what they're doing, so they just put their money inside their bank, which is that's completely fine. That's fine. There's nothing wrong with it. It's just that you don't know what you're doing, right? So I have, let's say if I have right over here $30,000, okay, I'll put it inside ETF or allocate it inside ETF, then cash is going to be $25,000, right? And then there's going to be obviously right here, sorry, my bad, 1 second. Then there's going to be stocks, which is left with 45% in stocks. All right, so this is going to be $45,000. Right, this is going to be $45,000 right here. So this is how, as an example, I would allocate it if my percentages are like that. Right, this is how I allocate it if my percentages are like that, which is also the reason why, but earlier before I told you guys to look at this over here, and can you see that? You guys can see the screen, right? Can you guys see what I'm sharing right now? This. I'm not sure whether the white. Can you guys see this part? Start thinking of an asset allocation parameters. Do you guys see that? Yes, no? You guys see this? My screen, do you see that? No? Yes? Oh, just the whiteboard? It's just the whiteboard? Oh, so I can't shift from whiteboard because it's gonna remove everything. So over here you can see that this is how I do my stuff. Now let me share something a little bit more personal with you guys, right? This is fine for me because I already have like this stuff that I'm already doing. So let me just share, what I'm actually showing. Hold on 1 second, yeah. Can you guys see what website I'm on right now? Yes or no? Can you guys see what website I'm on right now? Yes or no? Okay, all right. Hold on. Oh man, I can't remember my password for this. I'm sorry guys. I wanted to show you guys this, but can't remember my password. Okay, it's fine. Let's move on first. Okay, so remember these are money that you're not willing to touch, right? I would say like you have money sitting inside the bank, but you don't know what to do with it. Then you take it out and put it inside the market. Okay, and we're talking about huge amounts over here, and that's fine because we're putting inside safe investments. We're not putting inside risky tickers that can go to zero and stuff like that. We're putting that inside safe stuff. Right. So this is as I'm an aggressive investor. This is how I allocate my funds. Remember, the numbers can be tweaked. You can tweak it to 20%. 35% over here, or maybe, if you are an aggressive investor but you don't want to put too much in stocks, can be 25%, can be 45%, and then over here will be 30% ETF. You can do that too, right? It's up to your individual self. Okay? Or if you're a passive investor, then you don't want to be dabbling into individual stocks, then just do this too. Right? Relatively, these are pretty much safe over here. Right? So that's that, right? This is how you can diversify your wealth so that you can let your money work for you. Otherwise, you're just putting inside the bank and letting inflation, destroy your money, as we go along, right? You can put inside the bank and earn the interest, that's fine, but there's not much. Okay. So next one over here is going to be diversifying into different industries, right? So for example, if we have $45,000 for the stocks itself, okay, I would say that a good amount is for you to invest 10 to 20%, okay, into a stock, right, that isn't of the same industry. So this is to protect your portfolio in case there's a drop and whatnot. So for example, if I have 20% invested in a stock from the energy, right, let's say sector, then I'm not going to invest any more money inside the energy sector. Right? I'm not going to be investing any more money inside the energy sector. Now, this is only unless you know what you're doing. Unless you truly understand the company, then you want to put 100% of your investment money, right? Investment money inside the stock, then fine. And this is unless you know what you're truly doing. Right, diversification is good, but if you really know what you're doing, then I think this is fine. Because this is how you can really grow your money quickly. Okay? Right? But otherwise, if you have 10 to 20% inside consumer staples, then you wouldn't want to saturate your portfolio with too much of this consumer staples right now. Right? You don't want to saturate your portfolio too much. Because if let's say you're in during an economic event where consumer staple stocks are not performing really well, your portfolio is gone down, right? It's absolutely destroyed, right? Your portfolio is absolutely destroyed. Yeah, it's done. Okay, because everything is in consumer staples. But if you diversify it, sure, maybe consumer staples is let me see, maybe consumer staples over here, right, goes down. Okay, but at a point of time when during the economic event, it's very good for energy, right? And then you have some energy and it goes up. So, but it balances out your portfolio. You're not like that bleeding out and whatnot, which is okay. But like I said, unless you truly know what you're doing, right, and you want to put more investment into that particular sector or whatnot, it's best to diversify. Okay, all right. Obviously, I do not own stocks from every single one of these 11 industries, right? At the end of the day, you still want to invest into companies that you understand. Okay, not just because it means that PPT says that there's 11 sectors, so I have to find 11 stocks for me to invest in. No, right? I do not have investments in materials. All right, I do not have investments in healthcare. I don't have them. Right? I don't have financials as well. I got real estate. I got tech. Oh wait, no, financials I have. I got an insurance one, Earnum Group. Right? I don't have financials. I got that recently. I don't have healthcare, right? I do not have communication services. I do not have this. But these are just because I just do not like these sectors and stuff, so I try not to invest in them. Right? Okay? So this is how you can manage your this is how I do it, right? This is how I manage my risk. So there is that. So the last one over here is going to be the more important one, right? I think it's the one that everyone of you guys will be excited for. Is how can you make semi-passive income a long-term fix? Okay, so this is obviously a concept that a lot of you guys probably don't know about, right? If you guys don't know about, okay, look, some of you guys over here don't know what the stop loss is. Okay, if you guys don't know what the stop loss is, I think you guys probably wouldn't know what this actually is. Okay, so let me just show you guys something right now. Let me just try to reset. Okay, it's reset it. Okay, look. So this is a playback function, right? I have to do a playback function because the market is closed right now. So I can't really show you guys a live example. Okay, but this is good enough, right? Because I want to show you guys how the effect of doing this is. Okay. So let's say, right, I'm gonna get some engagements over here right now. Okay, can you guys see the whiteboard? Can you guys see the whiteboard? Yes, no, yes, no, yes, no. Okay. All right. Cool. All right. So let's say you want to buy. Okay. Let's say after everything we talk about, right? Let's say you want to buy Apple. Okay. To you, Apple is valued at $40. Okay. The market price right now is $70. Are you going to buy over here? Yes or no? For example, if you know that Apple as a stock is valued at $40, but market price now is 70, would you buy it at 70? Yes or no? No, because you know that this is supposed to be, it's not worth $70 per share, right? It's worth $40 a share, right? Guys, I'm giving an example. Yeah? I'm not saying that Apple's going to go to 40, yeah? All right? So you guys will not be buying it at $70 a share, right? It's because you know that it's overvalued. Okay, so what would you guys do? For those of you guys who say no, what would you guys do? What would you guys do? Huzaifa, Ziga, what would you guys do? Wait for it to drop, right? So, traditionally speaking, all of you guys over here, right, would wait for the price to drop. So it could take 2 years, 3 years, 4 years, 5 years, doesn't matter, right? But you'll just wait for the price to drop back to whatever the value is at and stuff like that. Right? And while waiting for the price to drop for 2 years, do you make any money from Apple? Yes or no? If let's say let's say this is in 2023, right? At 2025, Apple is finally at $40, right? Well, now from 2023 to 2025, did you make any money from Apple? From 2023 to 2025, did you make any money from Apple while waiting for the price to drop? Right? No. Correct? Okay, so this is how traditional, or rather I would say most of the people in the common public, right, would react like that, right? Oh, I know that this stock price is worth 40, current market price is 70. I'm just gonna wait for it to drop, right? And then while waiting for it to drop in the past 2 years, they don't make any money from Apple. Finally, it's at 40, they buy into it, right? So this is generally what people will do, and this is what generally people will say as well. People who don't understand the market, don't understand, how to invest, they would just generally say like that, right? This is a very common answer. But if you know what you're doing, there's this trick for you that between 2023 to 2025, you can still make money from Apple stock, even if you do not own the stock. All right, and this is called cash secured goods. Okay, or we can say options right. This is you can go to YouTube and look more about it. I'm gonna try to explain it in a way that's simple for you guys to understand. But this is called cash secured puts, options right. Okay, I'm gonna show you guys an example right now. Yeah. Now, let's say I've really tested the thing, right? So let's say this is my account, right? I have $100,000 in my account. Okay, I have $100,000 in my account, and look, I wanna invest in let's say, for example, IWM, right? I'm just giving an example. I'm gonna show you guys how this thing works. Okay, so for me, I understand that IWM's value is $187. Right now it's 187.65. I don't want to buy it here, right? I want to buy it at $187. So I'm going to look at this right here. Okay, right? Now look at this, okay? Options buying power is 100,000, right? Everything's 100,000. I have 0 position in anything. Okay, so over here, cash in vehicle tells you how much cash you have in your account, right? So if you make money, if you make $1, this will be $100,000, $100,001. Right, this will be 1 over here. Okay. So I'll give you guys an example, right? So let's say if I were to buy this right now, right? 100 shares at 180 something, whatever. Okay. So buy right now. You can see that my option buying power is reduced to $81,000. Why? Because I have 100 shares at 187.78, right? 187.78 times 100. This is a 18,000 I spent, which is why this is down, this is down. Okay. But the net liquidity moves up and down because I'm in the trade. If I'm profitable, then my net liquidity is profitable, right? This one counts the P&L, but this one doesn't. This one counts what is value add. Okay, so let's say if I were to sell right now. Okay, if I let's say I were to sell this 100 shares I have right now. Okay, right, let's say I have it at 187.78. I'm going to sell it at 187 point, see, let me take the price over here first, yeah. Okay, 187.81. Okay, you can see that I've made $3, right? I've made $3. You can see that right here. I've made $3 right here. Do you see that? Right, and this is what you want to be looking for. Your cash and sweep vehicle tells you that right now you have $103 in your account. Okay, this over here is the buying power. So if you have, for example, a stock, right now, if you have the stock right now inside, this is gonna go down, right? But this tells you the total amount that your money has. So if you make money, this thing goes up. To put it simply. So we talk about just now, right? So based on earlier scenario just now, we talk about, okay, look, if let's say I'm in the stock for if I'm in the stock for, or rather, if I know that the value of the stock is, for example, 187, right? I don't want to buy it here. I want to wait for it to drop. So generally, what most of you guys will do is, I'm going to wait for it to drop before I start buying it, right? But what if you apply this method of, cash secured puts or option selling, options writing, okay, what you can do is, if you do not have a stock, okay, if you do not have a stock, right now we don't have stock, we're trying to buy it, right? Go over to the put side. We start under the bid side because we're selling it, where we're selling a put. Okay. So what we're doing is we're telling the broker that by 8th of December, okay, if the price hits $187, I will buy 100 shares of IWM at $187. Okay, so that means that you also gotta have cash to buy 100 shares of this when you do this, right? Don't do this if you only have $5,000 in your account and you start doing this. No. All right. It's very dangerous. You're gonna get margin call and you're gonna blow up your account. You gotta make sure that you have enough cash to do it. Okay, so 1 equals to 100 shares. If let's say this thing triggers, you have to buy 100 shares at $187, which is completely fine because you know that this is what the stock is valued at. Okay. So I'm gonna do this right now. Now look at this. This right now is 133. Okay. I want you guys to see this cash and sweep vehicle. This thing is gonna go up when I do this, because when I do this in the spot, I make 136 on the spot immediately. Right? Basically, this money is mine. Right? Let me show you guys. See that? I sold it for $135 based on the system. So basically, on that day itself, I have made $135. I have made $135. Now, I have an obligation though. I have an open obligation right now that expires in 2 days. So what happens if IWM, so now there's 2 scenarios over here. One is if IWM stays above $187 by 8th of December, what happens then? Right? So let's go over to 8th of December right now. Let's go to 11th of December. Okay. So by 11th of December, you can see that IWM is, let's say for example, at so this is a little bit of a, it's a replay, so it's a little bit laggy, right? But let me just, so you can see right here, IWM is still at 180, so it's 186, right? I think it was 187 in the morning. Let me just see, because I did this example just now. I'm trying to find a good example for you guys because it's hard, it's not easy to see 930. So it expires, right? So what happens over here is that the contract's gonna expire and you don't buy the stock. So basically you pocket $135 on the date sale. Now remember, see, right now it's 137, right? This contract is gonna expire, right? And you basically don't do anything. You do not have to buy the shares, you do not own anything at all. Right? Everything, the money that you make, it's 135, is made on the day that you did it. Right? It's not given to you after this contract expires. No. Right? It's made on the day you do it. Right? One great way to kind of make sure that you guys understand this is let's say, for example, you are a travel insurance agent. Right? Now, for example, if let's say you go overseas, do you guys buy travel insurance? Do you guys buy travel insurance, guys, when you guys go overseas and stuff? Yes or no? When you guys go overseas for a long period of time, do you guys buy travel insurance? You do, right? You guys will buy travel insurance, right? So if you buy travel insurance, you pay the agent money to keep the travel insurance active, right? You pay the money to keep the travel insurance active, right? So right now you are the agent. When you receive the money, the travel insurance is active, correct? But if let's say there's something happened during the trip, then obviously you have to exercise the travel insurance, right? And that's what happens over here. If let's say this thing goes under 187, you have to exercise it by buying 100 shares at 187. Okay? But what if nothing happens in your trip? Can you go back and tell your travel insurance to give you back the money that you pay for the travel insurance? Do you think it's gonna happen? If nothing happens, let's say you bought a travel insurance, right? You go overseas, you come back, nothing happens. Can you get your money back from the travel insurance? Yes or no? You cannot, because the insurance has expired, right? You paid for it to be active during your trip. Nothing happens, you come back in one piece. The money you paid is done, right? So same thing. Right now, what we're doing over here is that we are the agent selling the travel insurance. Okay, the person that paid us this money, $135 on the day you do it, it's your money already. You don't have to give it back, right? This is your money already, right? This is your money already, right? And if nothing happens, then this thing expires. Do you have to give this money back? No, it's yours. This contract expires, and what you do, you repeat the process again. So from 2 years, how much do you guys think you guys can make extra money from if let's say it never actually hit your price? Rather than just waiting for the price to drop, you're making some money over here, isn't it? Right? At least you're making something better than just waiting 2 years to do nothing. Isn't it? Right? You see, all you guys over here were telling me just now, if Apple is if I know that the value of Apple is 40, market price right now is 70, I'm just gonna wait for it to drop. And it drops to 40 in 2 years. Within the 2 years time, you're making nothing of it. You're just waiting for it to drop. But if you know how to do this, within 2 years, you can make extra money, even if you don't own the stock. Right? You can make extra money even if you do not own the stock. Yeah, you can see right here, the money is yours. The contract should have expired because this is replay trading, so it's not really showing itself, right? Now you don't have to buy it back. The contract is just gonna expire, right? So you don't. It's not. You should be up 100%. By the way, this is just replay trading, so that's why it's a glitchy, right? I don't lose sleep. Why do I lose sleep while waiting for expiration dates? Why should I lose my sleep? If I know that the value of this company is $70, right? And I tell myself, okay, look, right now the company is at $80. I don't want to buy it here. I want to buy it at 70. Even if it goes down to $60, $50, I'm okay holding it at 70. Why? Because I know that this company is valued at 70, right? If it goes down to 50 to 60, remember, stock price doesn't measure the value of the stock. It's being, stock price is being, I would say, is being influenced by human emotions, outside catalysts, fear, right? Human fear, massive sales. But does it mean that the company is bad? No. I'm okay with it, right? I'm okay because I understand that this company is valued at $70. So even if I do exercise it, why would I lose sleep? The moment I press this button over here, I'm already prepared to buy this 100 shares at $185, right? So if it hits, it hits. It doesn't hit, I make extra money, and then once it expires, I go on to the next week and do it all over again. I go to the next month and do it all over again. I just keep doing it. Yeah, you hold it because it's a good company, right? You don't need to lose sleep over it, right? Why do you have to lose sleep over it? This is not applicable for small caps though, because you don't know. These small cap companies do not make money. You don't understand them. You know that they're trash, right? So if they can't even go zero, so you will lose sleep over it. But why would you lose sleep over this? Right? You shouldn't, because you know that this company is worth this price. Eventually, if the company is good, it will go up. But I'm gonna tell you guys that like, so there's that. You do not lose sleep over it, right? But there will be, again, when you put your money in the market, you gotta be prepared to take losses, right? That is just how the market is. You gotta be prepared to take losses. Okay, this is just a part of being in the market, right? But that's why you diversify your portfolio. You don't go all in unless you truly know what you're doing. Okay. Now the second thing is if you own the stock, right? If you own the stock right now, let's say, I'm gonna close this up. I'm gonna give you an example. Apple. Okay, let's say Apple, right? Let's say you own 100 shares for Apple at $193. Okay, let's say you got exercise and you got 100 shares at, let's see, why is it not exercising? 1 second. Okay, let's say you got exercise, okay, and now you have 100 shares of Apple at 192.84. Okay, and you want to now, if you sell it over here, are you making any money? Sure, you make 850. It's pretty shit, right? You make 850 is pretty shit, right? So you tell yourself this, okay, look, I know that Apple, okay, I want to sell Apple at two, let's say, I go to a month out, right? Let's say 25 days away, okay? And I tell myself this, okay, you know what? I want to sell Apple at maybe 195, for example. I want to sell Apple at 195, right? For example. Okay. So if I sell Apple at 195, I'll be making a profit of $3 a share. Or rather, if I sell this, say this at 192, it's easier to kind of understand. Right? It'll be $3 a share, I'll be making a profit of $300. Okay, and I want to sell Apple at $195. Okay, so again, let me ask you guys this. When you want to sell Apple at $195, right? Right now it's 193. What would you guys do? So generally what you guys would do is you guys would just wait for it, right? You guys would just wait for Apple to go to 195, then you guys sell, correct? Yes or no? If right now you have 100 shares of Apple at 192.84, you want to sell at 195, okay? What do you do? What do you do? No, you'll just wait. You'll just wait for the price to go up, right? So while waiting for the price to go up, right, you're not really making any money out of it. Okay, but again, same thing. You can do it when you don't have stock. You can do this as well when you have the stock. So what you're doing right now, you're telling your broker is by 5th of January, or the date right now is 11th December, right? 5th of January, if Apple is 195 or above, I will sell all my shares at 195. So even if, let's say, Apple is at 197, $200 by 5th of Jan, you have no choice but to sell at 195. But is that okay for you? That's okay for you because your average price is 192. You don't lose, you make money, right? So you do this, look at this, right? The price right now is 264. Your account will be up $200 plus. You will see this up 81,000 right now for cash and sweep. Why? Because you make money on spot, right? So you do this over here, 81,000. You just made $270 while waiting for the price to go up to 195, right? You basically make money without selling your stock. So if let's say by 5th of January, same thing. By 5th of January, if the price doesn't go to 195, maybe it's at 194.90. This contract is going to expire, right? And you keep your shares and do it again. Rinse and repeat until you sell your shares away. And let's say, for example, at 5th of January, right? Apple is at 194.90. So it's cutting it very close, right? And you feel like, actually, you know what? I don't want to sell at 195 anymore. I want to sell at $200 instead, which is going to be additional $5 of profits for you. Then do it at $200 then, right? Do it at $200 then. Then you can get another round of money over here. So either way, you're going to be profitable regardless. You make money if you don't sell it. If you sell it, you make money as well. And then once you sold, you want to buy it back again, do this shit over here again while we're waiting for the price to drop. You make money both ways, whether you have the stock or whether you do not have the stock. Right? You gotta at least have, okay, so the catch over here is that you gotta at least have minimally 100 shares to do this. And for this over here, for the put, right, you gotta make sure that you have the cash to buy the stock if you get exercised, so that you do not blow up your account. You can, right? You can choose super outrageous amount like 250, but you see that there's no value to them. So you don't earn a lot. For amounts like this, you want to go super far out, right? So you can tell like I want to sell Apple at 250. So in 284 days, then yes, there will be some value in your contract after, right? You can see 149. You can do that, right? Or you can just be like, I want to sell Apple at 100. Or if some of you guys maybe over here don't mind just selling it for $3 per share, you want to just do like, I'm gonna sell Apple at $200, right? Over here. Okay, but this is expires at 284, right? So if let's say by 12th of January, Apple hits 195, okay, you're gonna even though this thing has expiration in 284, it's still gonna just sorry, if by 12th of January, Apple hits $200, which is exactly what you did, right? Even though you have 284 days to expiration, your contract is just gonna expire, right? Basically, your shares is gonna be sold at $200 a share, which is it fine for you? Do you lose sleep? Will you lose sleep? Yes or no? It's up $8. I mean, you make $800, and if you do this over here, you make, right, 1.5K on the spot. You make 1.5K on the spot, right? You see right here, right? This is gonna be 182,000. You make 1.5K on the spot because this is $1,500. Yeah, you can do that, right? You just have to make sure that obviously I'm sharing this over here for you guys, not to tell you guys that it's you guys should make money over here. The main money that you make in investing these stocks is still by capital appreciation, right? What do I mean by that is by when you buy a stock and you sell it, okay, at a higher price. This stuff over here is additional extra, like I said, additional semi-passive income for you, right? When you're waiting for it to do something. Okay, it's still at least better than zero. Yeah, imagine if it goes to 400, you're gonna be like, oh fuck, I sold at 195. Because if Apple goes to 400, right? Then this would have just made you could have just been missing out on $20,000 of profits. But again, you see, that's an imagine. You wouldn't know, right? So you don't have to go like you can go like super far out. You want to be like more. You know that the Apple is you can hold it for like 10, 20 years and stuff like that. Then you want to go like super far out. You want to be like, you know what? I think that by 20th September 2024, Apple wouldn't be at 260. But let me just do it here to make extra money. You can do that. And this is only if you have 100 shares. If you have 400 shares, then this thing is gonna be times. You can do it 3 times, you can do it 4 times, right? And then your money that you make is gonna be more. I have this over here. My investment account is, I've been building it since 2020, right? And then the COVID period really helped me grow my investment a lot. And right now my investment is around 7 digits, right? My investment account is 7 digits. But by doing this, I'm easily making it around low to mid 5 digits just by clicking buttons like that every month. Just by clicking buttons like this, I'm making low, I'm basically, it's basically passive, semi-passive, I would say. You're done. Right? But you see, this is why a lot of you guys over here, if you guys do not understand, right? If you guys do not understand how to do the market, it's very dangerous. But if you understand what to do with the market, right? Take your money off in the bank. So, because this is safe. Unless you, you have to know what you're doing though, right? If not, a lot of people over here, they put their money at the bank, thinking that the bank's going to grow the thing. It's just a very traditional way of doing things. But you and I both know, right? The only thing that the bank does for you is honestly nothing, right? I mean, inflation is going to fuck your money up. That's all. But when you do this, right? If you put like $80,000 inside your account, remember this is safe. Your $80,000 is not going to be gone because you're not buying stuff like Nuke, or you're buying Apple, you're buying Nvidia. 80,000, is it going to be gone? No. But while waiting for it, you're making all this extra passive income. Semi-passive because you need to click your buttons and stuff. Right? You can make money. And I'm pretty sure the bank will not give you, $180 in 25 days. Right? Is it going to give you $180 in 25 days? No, it's not going to. Yeah, so that's why I'm telling you guys, right? This crash is good. This crash is good. It's good for a lot of you guys over here. I mean, if you guys know what you guys are doing. Okay, all right. So if not, I've come to the end of my sharing session. 1 second. I'm gonna pause this right now. I'm gonna stop it actually.